The mainstream media will tell you that companies that make your favorite brands and products like Pepsi, Kit Kat, Tide, Gillette, and even toilet paper companies or Huggies and Pampers are raising prices so much that inflation is going to spiral out of control and we are going to go into a stagflationary depression. And the mainstream media is doing this all while selling you doom, gloom, and fear. After all, they say Pepsi raised prices, Nespresso, Kit Kat 9%, diapers 10%, toilet paper 10%. Everyone's raising prices. And obviously, once the inflation genie is out of the bottle, there's no way you could put it back in. And quite frankly, the only way out is a deep, dark recession or depression. And it all starts with the banking crisis. So the best way to protect yourself is obviously to just buy gold, buy silver, buy guns and ammo because we're screwed. But wait, is that really what's going on? Or is this just what the mainstream media is spinning to us? Is it possible that the mainstream media is blatantly lying to us? Well, yes, but are they about inflation and financial news? Or could companies like Bloomberg potentially purposefully be misleading the truth to sell more news? After all, if it bleeds, it leads, right? Well, here's what we're going to talk about in this video. What's actually happening at these companies? 1. 2, what the Fed is actually doing. And 3, how to position ourselves. In this video, I'm going to reveal to you what I just uncovered. By the way, congrats to all of those of you who appreciated what I last uncovered when it came to the fundamentals of Opendoor, which back on April 19th and 20th and for the last few weeks was actually selling for below book value if you actually understood the balance sheet. And when we talked in our course member live stream about this stock potentially going to $2 or $3, well, let's just say it started. Even though I hate Opendoor, the fundamentals had shown that Opendoor became substantially oversold. Here's a clip from my course member live stream when I talked about it. This could become a $3 stock as quickly as the next earnings cycle. So it's pretty wild. Companies up over 51% at the time of this recording, over $2 again. Bill.com, another one we did a course member fundamental analysis on before earnings. AI and autonomy with recessionary pricing power and technicals that put it within 13% of the bottom. In my opinion, just pretty juicy. Up 34%. So, if you want my fundamental analysis for life, get in before May 10th. There's a massive price increase coming of over $120, especially after we add massive lectures on productivity with artificial intelligence in the new program on how to make more money and get SH9T done faster. Email us for bundle coupons at kevin@meetkevin.com. And keep in mind, this is the Elite Hustlers course that's now rebranded, and all of the AI lectures will be coming out on June 1st, and then we'll keep them updated as well. That's the beauty. You get lifetime access to all the updates, the content, the course member live streams, you name it. So let's get into the content. First, what's really happening? Well, the best way to understand what's really happening is to actually look at earnings calls, which is what CEOs and CFOs, so chief executive officers and chief financial officers, are actually telling us that their companies are doing and planning on doing. And usually these companies tend to be optimistic in their earnings calls. So if they're being pessimistic, you should believe them. It's actually potentially worse. In other words, if a company says, yeah, we could raise prices 10%, great, that's optimistic, and that would be dangerous for inflation. But if a company's like, maybe we'll be able to raise prices 3%, that's a sign that they probably won't and that disinflation is coming. So what are companies telling us? Well, let's start with Proctor and Gamble, who makes daily goods like Oral-B dental products, Tide, Olay, Pampers, Gillette razors, Old Spice deodorant, Vicks, Crest toothpaste, Gain, Swiffer, you name it. Well, what are they saying? Quote, they see price stabilization and pricing either neutral or negative, and that pricing will actually end up becoming a negative headwind coming up. Wait a minute, what does that mean in English? What does it mean to have a negative headwind for pricing. Well, when you listen to these finance people, it sounds complicated, but there's a really easy way to picture this. So let me show you. Here you go. I drew this chart out, and on the top you could see 2022. So let's say it's January, it's the beginning of 2022, and we have a product that we sell for $100. And now in, say, April, or in the second quarter, so say these are all quarters, right? Q1, Q2, Q3, Q4. Say in the second quarter we raise prices $10. Well, now we have a 10% quarter over quarter increase. And now in the next month, we maintain pricing, or next quarter, we maintain pricing at $110. Okay, still 10% increase compared to the year before, right? $110 the next quarter, still 10% increase compared to the prior year. $110 the first quarter of 2023, well, comparing back to the prior year where prices were $100, that still shows a 10% increase. And what just happened, folks? January to March was quarter one. January, February, March. That was quarter one. And companies are talking about and bragging about all this extra 10% of pricing benefits they were able to take, but they didn't actually take that pricing in Q1. They took that pricing last year when we had a lot of inflationary issues and a war that just started in Ukraine. And now, if you raise pricing in, let's say, April or May, like today, another $2, technically you've still raised pricing, but what just happened? You hit something known as a lap. When you lap in finance, this is really important, when you lap the year-over-year numbers, your pricing benefit goes away. See, for an entire year, you're able to say, yeah, we've raised prices by 10%. Yeah, buddy, we've raised prices 10% because people love our product. No, you raise prices once, and then you gloated about it for a year. Now, your next price increase is only $2, which on top of the last one is actually only a 1.8% increase. That is way lower than 10%. Yet, the mainstream news is bragging about this 10% price increase for these greedy corporations right here, where the yellow mark is. Basically at the end of their party to be able to brag about it. And they're doing that to sell you fear or gold. In other words, look at this chart. This shows it to you a little bit more when you look at this closely. So picture the orange line. Pricing, the orange line in 2022, we'll follow it here with the little red laser, okay? We raised prices in Q2 2022. Oh, 10% inflation. Brag, 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 brag for an entire year. We lap to the next year, 2023, still got that 10% increase over the last year, right? And then what happens? Oh, now we're gonna lap. So now we're going to only raise prices, say 1.2 or call it 1.8%, which is what we had above. Now your year over year inflation actually drops to about that 1.8%. Let's fix that over here, make that 1.8%. There we go. And now all of a sudden, you don't have that much to brag about anymore for the rest of the year. Huh, interesting. And is that what companies are actually saying? I mean, so far I've only given you an example of Proctor and Gamble, right? So this would be really useful to understand what other companies are talking about, because now that we know the price lap phenomenon, it makes sense that maybe the news could potentially blatantly lie to us and say that pricing is actually higher year over year. Well, that would be true if they actually told us it was year over year, but that's not what they're doing. In fact, take a look at this. Here's an article where Bloomberg just today was talking about how sticky inflation is and how much inflation there is and why you should be fearful. And they literally wrote this. I can't make this up. Case in point. Their case in point, folks. This is the crux of Bloomberg's article in terms of why you should be fearful. And if you like what I'm about to tell you, I encourage you to like the video because nobody else is talking about this. You ready for this? Case in point. Kimberly Clark. Okay, they make Huggies and Kleenex and toilet paper, right? Dallas maker of these things raised, this is their quote, raised prices by 10% across all its categories last quarter. Wrong. They did not raise pricing by 10% last quarter. They raised pricing last year, and they are realizing that now, and they're cheering about that now because year over year, yes, it looks like pricing year over year is higher. But they didn't tell you that in that article because that would defeat the purpose of that article. That article is supposed to make you fearful that pricing is still rising. But no, the party is about to end. Well, let's look at the earnings call for Kimberly Clark and let's see what the CEO of Kimberly Clark literally just said in their earnings call. Quote, We don't expect that pricing strength to remain and those pricing gains to remain. In fact, considering pricing inclusive of, volume and pricing growth, they think they're only going to grow revenues by 3% at the midpoint going forward. In fact, they think that pricing will become a, quote, headwind as they lap higher pricing. They expect, quote, pricing to subside, which means fall. It won't be a benefit anymore. And instead of raising prices more, guess what Kimberly Clark wants to do when it comes to Huggies diapers and toilet paper? They want to invest in, quote, innovation and advertising, because they have a new strategy, and that strategy is called the high road strategy. The high road strategy is one, rather than just cutting prices, we're gonna stand behind our brand and tell people, we'll shove the value of our product down people's throats, and they'll love our toilet paper and diapers because we won't drop prices, we'll just advertise and innovate more. So you literally have the CEO of Kimberly Clark going, our bath tissue is highly innovative and high quality. Really? You have a diaper and paper company telling you they're going to focus on innovation for their toilet paper, and then they're going to advertise more. Guess what's going to happen when their high road strategy fails? Folks, when Kimberly Clark fails to innovate toilet paper and diapers, prices are going to drop like a rock because they won't have any pricing power. These consumer staples, like those on screen, are selling you fake pee-pee. It is faux pee-pee at its best. Fake pee-pee. That's the best case scenario. Worst case scenario, it's a lie of a pee-pee. They're lying to you about the size of their pee-pee. Think about this. These staples are massively overvalued, and I personally expect when these companies realize they're going to have to massively cut prices, then you're going to see the gains of companies like Kimberly Clark and Pepsi evaporate. And these staples, the people who are investing in them for a flight to safety, will actually end up rotating to growth companies. Unfortunately, in the meantime, people are fearful because they read the news headlines. Reading headlines is extremely dangerous. You should know that if you're on YouTube. Now, what does Pepsi tell us? Because maybe Pepsi is going to tell us something different. And what is Ford saying? Because maybe these companies are going to tell us something different. What about Norwegian Cruise Lines or Costco? I'll tell you exactly what all of those companies are saying right now. But I want to shout out Gary Vee. He's the hustle man, right? What did hustle man just say your duty is? He says your duty is to make sure that artificial intelligence does not replace you.
If you are not using AI tools every day of your life, you're making a huge mistake. You've got to start training. Whether you need it or not is irrelevant. You're gonna need it. This train has left the station and there's nothing stopping it.
And yesterday, a course member thanked me for helping prevent him from losing his job in that course. And this is why I remind you to check out the bundle coupon codes by either going to meetkevin.com, go to the link down below, or email us at kevin@meetkevin.com. We have already set the price increase for the courses on building your wealth for 11:59 p.m. on Wednesday. The price will go up $120, which is a pretty sizable increase. If you jump in now, you'll guarantee the lowest price forever. Use that link down below. But keep in mind, this is a very, very high quality course with custom live streams, all focused on making you more money, whether you are an individual employee or you're a business owner. Doesn't matter. Employee, business owner, doesn't matter. We want to make you more productive and make sure you can make more money and you get through this difficult economic time in the safest way possible. Link down below. So, what is Pepsi telling us? Well, Pepsi is telling us, quote, we're seeing a deceleration of inflation, and quote, the majority of pricing is already done. In fact, quote, we have mostly taken the pricing this year that we needed to cover our costs. Now, they don't quantify exactly how much pricing they're taking this year because it's probably embarrassingly low. Say it's 1.8%. You're still technically raising prices, but it's nothing to phone home about. It's no 10% increase anymore. So Pepsi isn't bragging about big numbers because they don't have big numbers anymore. They're cheering about last year's pricing in the news, but that's all going to fade. What makes a consumer staple like 3M talk about pricing? Well, price declines. See, 3M manufactures products like tapes, filters, bandages, Post-it notes, along with a ton of other things, like 60,000 products. And what do they see? Quote, inflation in the low single digits. In fact, that's the average guide for the year. In English, barely no inflation. What about Nestle? They were just in the news for raising prices on Nespresso and Kit Kats by 9%. 9% inflation. Oh my God, these Nespresso pods getting so much more expensive. Well, what are they actually saying in their earnings calls? Here you go. Quote, we're not taking broad-based price increases. Much of the pricing that will apply in 2023 is pricing that has already been effectuated from the second half of last year. The consumer is, after all, being more sensitive, they say. Interesting. What about Norwegian Cruise Lines? I mean, come on, man, Kevin. You can't just pull out Pepsi and Proctor and Gamble and Kimberly Clark and Nestle and say these companies aren't seeing inflation. What about travel? All right. Norwegian Cruise Lines. They say it makes sense to hold pricing so they can focus on occupancy. In other words, if they keep raising prices, they're not going to have a full boat. And everybody knows that if you're going to be sailing a ship, you may as well be sailing at 100% occupancy, even if you have to give away the rooms. Because if you don't fill the ship, you got less people buying drinks and stuff on the ship, and less people buying art or whatever from their stores. What about Costco? Costco, that's a big deal, right? I mean, consumer staple, everybody's been fleeing to Costco stock. Well, Costco says not only are prices for TVs falling, duh, but what about for all of their inventory? What do they expect for potentially LIFO credits? I'll explain that in a moment. Well, they say they expect LIFO credits to be flat. Okay, little complicated. I'm gonna make it very, very simple. LIFO stands for last in, first out. I learned all about that when I was working at Jamba Juice. Some things are FIFO, some things are LIFO. First in, first out. Last in, first out. Depends what system you use. Well, if you use the LIFO system, that means you have a bunch of stuff on the shelf. And so you add new stuff to the front of the shelf, and then you sell the new stuff at the front of the shelf. You don't do that with like perishables, obviously, but on some things you do. And then you kind of leave some stuff back in the back of the shelves. Well, the stuff in the back of the shelves, you have to take an inventory adjustment on, which basically means you can adjust the value of your existing assets based on how much you're raising or reducing prices on your first out products. Well, now they're expecting that to be flat. In other words, no more of increasing our balance sheet because we're not raising prices anymore. In other words, in plain English, Costco's like, dude, pricing flat, man. Like, no, we're not raising prices. In fact, we want to, quite frankly, see prices reduced so we could sell more stuff. Yeah, that's Costco for you. Okay, well, what about Ford? Ford says they're gonna keep their prices high, and they're telling their investors they're not gonna pull a Tesla because they're not gonna cut prices, because cutting prices, just to get volumes is a bad idea, and Elon Musk is dumb. In so many words, that's what they're saying. Meanwhile, they're putting a mile of extra cabling into their cars because they don't know how to manufacture, and their margins at best case last year for electric vehicles was negative 40%. Last quarter, it was negative 100%. And their best case scenario is maybe they'll break even on electric vehicles by 2025. Best case scenario. So, well, but wait a minute, Kevin, but they say they're gonna keep prices stable and they're not going to cut prices. Ford is different from Tesla. Ford, like legacy autos, use the dealership model. The dealership model, guess what? Allows you to keep MSRP high while funneling money to the dealers so they can negotiate a lower price with you. So in other words, let's say Ford has a beach to sell you in Arizona. Well, they might say the cost of that is $60,000. And as everybody else is cutting prices, Ford might say, our beach is so desirable, we don't have to reduce prices. Meanwhile, they're going up to people going, hey man, Ford up there, they say this costs 60 grand, but what if I could get it to you for, 50 grand? I'll get you 10 grand off. And the person giving you the 10 grand off is the dealer. Okay, well, where does the dealer get that money from? From Ford's marketing budget. Yeah, Ford can literally, as incentives, distribute money to all of the dealers and basically say, we'll keep the MSRP high, but we'll hand money out to the dealers. Then the dealers give that to you as a discount. And where does that show up on the Ford's income statement? Advertising. So now what do the Ford executives do when they go on their next earnings call?
Yeah, we spent more money on advertising. Our ads and our brand value are so strong that we were able to maintain prices while increasing our ad spend to pump up volume. We didn't have to reduce prices at all.
It's a freaking scam. It's a scam. They're lying. That's what it is. It's fake PP. Faux PP. It's a lie. It's also, you could tell shareholders pricing is stable while just advertising more and handing it out of the back end. And the mainstream media is eating it up. So, what is the Fed actually doing? Well, let's be blunt here. If the Fed told you they were going to cut rates in September, I guarantee you, your mom and my dad, all together, would go out on margin and YOLO stocks. That would cause the market to skyrocket again. People would feel rich again and euphoric again. They'd spend money and inflation would skyrocket. Instead, the Fed is playing 4D chess. Or if you're actually paying attention to the chessboard, they're just playing regular chess. They gave us the exact formula of what they are doing. Yeah, they gave you a formula. Did you catch it? No. Did I catch it until now? No. I went back and rewatched it and I'm like, oh my God, here it is. The formula is linked down below. No, I'm just kidding. I had to. I'm sorry. Play the Fed.
We have the luxury. We've raised 500 basis points. I think that policy is tight. I think real rates are probably, that you can calculate them many different ways, but one way is to look at the nominal rate and then subtract a reasonable estimate of let's say 1 year inflation, which might be 3%. So you've got 2% real rates. That's meaningfully above what most people would, many people anyway, would assess as the neutral rate. So policy is tight, and you see that in interest sensitive activities, and you also begin to see it more and more in other activities. And if you put the credit tightening on top of that and the QT that's ongoing, I think you feel like we may not be far off or possibly even at that level.
So what does this mean? Folks, it's obvious. As long as 1 year inflation expectations out continue to fall, the Fed will probably be willing to cut rates soon. They won't forecast that until they're ready to do so, because then they would unwind what they're hoping for. Now, no guarantees. If inflation expectations don't come down, they won't cut. It's simple. If inflation expectations go up, they won't cut. If they stay stable, they probably won't cut. We need expectations to come down and inflation prove to come down. But let's do a little chart here, because right now, average 1 year inflation expectations are about 3%. There's some measures that are a little higher, like the University of Michigan Consumer Sentiment Survey. We have to watch that. It's been a little volatile. Last month it popped up into the 4+ range, like 4.6% range. That's not good. That's bad. But the Fed's preferred measure of inflation expectations came out today, and it came in at 2.9%. So let's call it 3%. Rates are at 5%. That means real yields are about 2%. Okay, that's what Jerome Powell just talked about. Now, if we show that graphically, what does that mean for the future of rates? Well, let's take a look at it here. On the left side, you see Fed rate 5%, inflation expectations 1 year out are 3%, real yield 2%. Okay, well, what if I now told you the inflation expectations end up falling to 2%, towards like September of this year, and the Fed still wants to keep real yields at 2%? Okay, well, if inflation expectations are 2% and real yields are 2%, then guess what interest rate you need? 4%. If inflation expectations stay at 3%, you stay at 5%. See where we're going with this? If inflation expectations fall to 2% and the Fed wants real yields to be 2%, they can cut interest rates 1%. Now, what if the Fed says, hey, inflation's fell to 2%, but not only did inflation expectations fall to 2%, we're willing to let real yields be 1%. Oh, well, simple math would tell you that the interest rate for the Federal Reserve that you need now is only 3%. In other words, 2 percentage points of cuts. 200 BP of cuts. There's the map for you. Literally the formula. I literally just gave you the formula for when the Federal Reserve is going to cut rates. And all you have to do is pay attention to expectations for inflation. That's it. That's all you have to do. It's simple. Expectations for inflation are relatively stable right now. And we look at the 5-year break-even chart, what we see on the 5-year break-even is actually a slow and steady kind of decline. Dare I say it's a Nike swoosh in reverse. Now, the 5-year break-even inflation rate is the bonds market expectation of inflation. It's very important. And I think when we look at it graphically, you could see this is something that does require patience. And this is why the Fed isn't talking about rate cuts yet, because again, A, it would ruin what they're trying to accomplish, because then people would just front run it. And B, we need to see this fall even more. Look at the 5-year break-even inflation rate on screen now. See on the right side how it's been declining? We want to see that trend continue. And we had a little bit of an oopsie-doopsie there briefly right after the January numbers came out, but we really want to see this trend continue. But beyond continuing, look at the last time the Fed really talked about pausing. It was right about there, right around 1.6 on the 5-year break-even. So watch this chart, because we're basically at lows of last year. And if this drops a little bit more, a couple more banks fail, we'll be right at that territory by September where the Fed's willing to suddenly U-turn. So what's the best investing strategy going forward? Hashtag not financial advice. Even though I am a licensed financial advisor, I run an actively managed ETF. I've got amazing courses on building your wealth. Email us at kevin@mekevin.com for the bundle. Price increase of $120 is already set for Wednesday. Yeah, we delayed that a little bit because I couldn't get back to all the emails. I think Monday morning McKay got in. He's like, what? Why are there like 200 emails? There's been a lot of interest in getting in before Wednesday. But anyway, what's the strategy? In my opinion, staples, bad. It's tough to short right now, though, because I think if you short, you're going to get screwed. You have to be careful because everything, rising tide lifts all ships. What's the strategy? Slow Nike swoosh. People think I'm crazy for saying this, but I've been saying it for 6 months. One of my staff asked this morning, great question, why 6 months ago did you come up with the Nike swoosh recovery? And my answer was very simple. Psychology. That's why I sell a course, Stocks in the Psychology of Money. I believe that people are not going to be convinced that inflation is transitory like an on and off switch. They're going to slowly realize, all right, inflation's coming down. And as they slowly realize that, they will slowly reallocate back to stocks, which is super unpopular right now. Stocks are pretty bearishly positioned. There's a lot of excess capital that should flow into stocks, and it will. I expect that. I could be wrong. I don't have a crystal ball. I didn't even buy one on Amazon to say I have a crystal ball. I don't think it's going to be staples and defensives. It's going to be growth and stocks that benefit from artificial intelligence, which is, again, why you should focus on artificial intelligence, because that is going to set up the next decade for some of the most insane productivity gains ever. And if you're not part of it, you're going to get left behind. I guarantee you, you will get left behind. You don't want to get left behind. I will hand it all to you on a silver platter. Everything we're doing to make sure all of my businesses are as efficient as possible. Whether it's in finance, in real estate, housing, property management, content creation, accounting, sales, marketing, doesn't matter what business you're in. Doesn't matter if you're an employee or an employer, doesn't matter. AI is going to be very critical. So the Nike swoosh is all about psychology. And I think we're going to continue to see the Nike swoosh happen. It will be volatile because there's always going to be BS going on, like, what's going on with the debt ceiling and all this nonsense. And that is a real risk. But let's just be real. When we actually look at what's been going on when it comes to the Nike swoosh, so far, all year long, it's been correct. And we're already on the 5th month of the year. I think it's going to take a while to hit those new all-time highs. But when the Fed, and this is what blows my mind, people are like, but Kevin, when the Fed starts cutting rates, this Nike swoosh, well, let's just say we've talked about it many times before. Check out my videos on Meet Kevin, Fed, Pivot, and learn all about it on YouTube. If you found this video helpful, share this video, subscribe, like, comment. Thank you so much, and we'll see you the next time. Goodbye. Now, I want you to know this. When it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced